Just look at the Fed fund futures rate, and I just look at, I thought, there's just something absolutely bonkers going on here. And do you know what? I sometimes wish I was back in the market. I've traded a few bond options in my time. I've traded a few equity options as well. And some of the bets that are being made, I mean, let me just pick out a random one. November 2024. By the end of November 2024, there is a 24% chance, which is the top of the bell curve distribution, that rates are going to be 2.75%. Really? By the end of next year? I can't see it, Michael. Can you?
No, no, the only way that happens is if you have a prolonged recession. You have oil prices that are falling. That's going to really give more juice to economic activity. It's going to reduce inflation rates. But, you know, what do you say? There's a minor chance. I think people are just speculating. But I think that, you know, when we get in these kind of markets where you have this sort of industry buzz, the AI or, you know, whatever it is, autonomous driving, people just go nuts. And do we ever learn? I guess we're all trying to learn. But the key for investors, I think, and certainly for your viewers, is to be skeptical. No matter what they hear me say or you say or anybody else say, think about it, look at it yourself, and ask yourself this question. Is this a reasonable stock given what we think the earnings are going to be for the next 5 years? If it's not, you're putting an optimism premium on that asset that you better be awfully sure about, because that's where really tears come.
How dare you, Michael? How dare you say that 26 times forward sales, not earnings, sales, is a frothy valuation? Quite extraordinary, Michael. I grew up in a world where 3 to 5 times was a decent amount to buy a company. Look, in terms of that, and I agree with you on probably 95% of what we're talking about here, there is no risk being appreciated either in the bond markets, as we just discussed there, the interest rate world, and indeed in the market as well. Are we setting ourselves up for a big fall in the second half of the year?
That's possible if, I mean, this is going to sound crazy, but if we don't go into slower economic growth in the United States and maybe even a shallow recession, that might be actually considered a negative, because interest rates might not be cut or might even continue to go up. If that's the case, that's the risk for the market. You're obviously going to see lots of companies guiding forward on a more conservative basis. Yeah, we see that happening. Obviously, layoffs suggest that's the case, that they should be guiding lower. But I think you have to be very, to me, it all really is going to come down to, is the economy going to touch near a recession? Believe it or not, if that happens, I think that'll be good news. If the economy avoids it and keeps on its frothy path, then I think we're going to have some problems in the market at the second half of the year.
Michael, can we just debate the motivation for the Fed here? Because I'm looking at a report from DataTrack talking about California, 2-month consecutive stretch of subpar growth, that a recession has to start somewhere. Maybe it's California. But what does the Fed do if it sees that there is evidence of a slowdown in the economy, yet it's still got a very tight labour market that is going to fuel wages, the wage price spiral? What does it do in that context? Does it cut because it wants to show up growth, or does it hold out because it's worried that inflation has not been tamed?
Well, here's the problem that the Fed has is cut is a really pretty drastic move. Now, we're all kind of used to it by now because they've been raising so much. But what you'll start to see, Karen, is they'll start trying to nudge things down without cutting rates by the speeches they give. In fact, you're already starting to see that now over the last 2-week news cycle. We have all these Fed governors coming out and making these proclamations to really sort of massage the market in whatever direction they want to go. The Fed uses interest rate policy but language to affect interest rates in the open market. And that's what the Fed will likely do, and then see how it plays out. They'll nudge first before they take decisive action.